So we were going to talk, you guys, once Darren jumps on about the self rental concept when a client has a business entity, and I think that it's something that has gotten a lot of publicity in the past couple of years, around, as part of the overall tax planning, whether you want to call it like a frenzy or a trend or whatever it might be. This more and more talk of tax planning techniques, the self rental, the Augusta Rule concept, for especially I think for S corporation shareholders, smaller S corporations, is kind of that one of the popular techniques that that we're told that we should know and feel familiar and be familiar with and be doing for our clients, right? So what we found though is that and not only just in the tax school network but in our own businesses of doing this kind of work is, hey Darren, we may not have this. Not all of us have like a really clear idea of when it's okay to do this strategy, when it's not, how to actually do it, and that kind of thing. So, with that being said, we have our guest of honor here, Darren. I was just talking, Darren, about how like the self rental and the whole Augusta Rule thing. It seems like it's something that everybody talks about, but maybe we don't feel as confident to actually implement. Would you agree with that, generally speaking? I can't hear you though.
There we go. Can you hear me now?
Yeah, your mouth was moving, but there was
Yeah, there we go. Yeah, it's that little guy. Sorry, getting back to it. 10 days out of the office, and 7 of them without cell service. So it was nice. I was up in the 20 miles deep in a canyon in the High Sierras. So
wow, cool.
Yeah, it was nice. So anyways, walked back in this morning from being out from 10 days. So sorry, I can't even get my headset right. So getting it back together. But highly recommend everybody, if you need a break, take one. It's good for the soul. Got to be a dad for a week, so it was awesome,
man.
With no work, good family time. So self rental, the Augusta Rule. The internet loves to play that one up. That like if your accountant isn't doing that for you, then I love the new one. Is your CPA or is your EA working for you or working for the IRS? That's the big label that's like on top of every post. And like, if you're not doing the Augusta Rule, then your accountant's working for the IRS and not taking advantage. But it's a lot harder to implement, and it's not as easy as the internet says to pull it off, because you actually have to do something. You just don't get to rent your house to your company for a week for $1,000 a day. Or $3,000 a day, or I've seen all types of levels of it. Accountants that completely and utterly take advantage of it, and do like a $30,000 payment for a week to rent the house out for a company retreat. And it's like, come on, you can't do that. And so, is it a red flag? I mean, if you're already in an audit, probably, yeah. You don't even put it on the return, so how much of a red flag can it be? So it depends on how high the rent already is on the entity return is where the red flag comes in. Really, it boils down to is, did something really happen or not? Like, did you actually have any venting rooms? Things of that nature. And then from there, you actually got to go online and find out like what's an event space rental, because the trouble you run into it on it too is, things they disallow in audit, like flying private. Like if it's $5,000 for a private flight and you didn't actually need to get there that fast, they'll probably discount that down to a normal coach ticket, from $5,000 down to $300. So if you got to look at fair rental rates, what would an extra, what would a different space have cost, things of that nature. So you got to keep it within fair market value, everything else.
So just to kind of, for the sake of this conversation, I think, and let me know, do you guys chime in here if you think this is a good way for us to take this, is like, let's say, I've done some of these myself, or, but again, we're just not 100% sure of like what the step-by-step process should look like, right? So I feel like, I want to, because if you, when you say things had to really have happened, right? Some of these things could happen in the future year, and so you're making like a suggestion that something would happen. Or maybe you're like, it's like the whole thing about remembering something different in the past that had happened, and now it's fitting into this little. So there's like, it seems like there's a little bit of gray area there. So like, just in terms of the first step of, I want to reduce my clients' taxes as much as possible, by anything that's legal and ethical. This looks at like an appealing loophole that I'm seeing on the internet or heard from a different seminar or webinar or whatever it might be. What do I do to assess, Darren, or how would you assess whether it's actually a legitimate use, and like what kind of uses would it be, that kind of thing? And let's imagine, I think, because it seems like it's mostly S corporation shareholders, I would say, that
Correct.
are utilizing this. So kind of like, what's the eligibility aspect of it?
So the eligibility aspect of it is, and let's look at it. So what the Augusta rule is just if you rent real estate out, your own real estate, for less than 7 days, you don't have to claim the income. Is what it boils down to. Or is it less than 14?
14.
14. Yep. Less than 14. So, where it comes in usually, so the ones where I use it for my clients legitimately outside of the entities is like, I have one client that is president of the homeowners association. She has an annual event there for the flowers every year. Costs her like $5,000 to do it, but they pay her to reimburse that. So, or like site fees when you rent your house out or driveway out or something like that to production companies. They might be filming for a day, things of that nature. Where the rule came from, they call it the Augusta Rule because of the golf courses, because it just didn't seem fair. People would rent their house out for like 2 days for these big golf tournaments, for like $1,000 or $5,000 a night. So where this is bled into is people suggest for entities to rent their personal real estate rent it to the corporation for this less than 14 days. You write it off as rent from the company, and then the shareholder doesn't have to claim it as income. So the situations where I see it, or clients that I bring it up to, are, one, is it a client-based business? So for your client, is what type of business are they in? Are they a service-based business? Are they a client-based business? Or are they, retail or online sales? So this rule really comes more towards clients, like client-based businesses, people-based businesses. Do they have employees? Is there a bigger staff? Things of that nature. There has to be something within their business that would even create the opportunity to have an event. So that's how you kind of need to first filter who you would even bring this up to. And, are they a local company, nationwide company? Is it all online? Do they have physical presence? Things of that nature. And then, so if they make that first filter and be like, okay, they could actually have an event at their house, then yes, the company could rent the house, from the individual to have an event. But even on that one, you're only talking 1 day. So, as far as on these, internet schemes and things of that nature, most of the stuff that they put on there, you can't even get more than 1 or 2 days of rental. So what are we really talking about here? So that's the big difference is, like, yes, you could do it for 13 days, but there's no real plausible situation where you would. And so if they make it through the first filter, and they could at least have an event, but you're also talking over the span of the whole year. So if they could have like a quarterly event at their house, or, if they're realtors, for them, though, if they're having, like client appreciation things at their house once a month, then you can get, 12 events out of it. So that's where you could get, multiple events on it. And then you got to look at the market rate of what it would cost to rent, similar size or space to have an event. So you got to, have some type of justification for the, event, the space fee that you're actually paying for. And so once you get that determination, probably between 800 to 1,500 bucks, maybe. So depending on the client and everything else, and that's where from these things is how much time are you going to put in, to get $1,000 deduction, not too much if they can only do an annual, but if it's some type of business where you could do something monthly, then you can get up to 12. So then you're talking, maybe $10,000 to $20,000 write-off over the course of a year. But you got to filter it down to the client you would even bring it up for. And for me, that's more the ones I bring it up to are the service-based, client-based, real estate agents, financial planners, things of that nature, consultants,
so team based. Like even if someone has vendors or they bring people together, they bring teammates together for a retreat or something like that. So
for a retreat, yeah, and then that would be and then the additional level would be is if they have employees, then you could have a company meeting that company retreat that night or maybe a day or two. I did have a client that he had which I busted him on anyway because. And this is where too is they actually have to do it. So I had a client that had a cabin up. We did the books for the company, but there was a different CPA that did the tax return, and he was reclassifying distributions as rent twice a year for the company retreat. And one of them was on a day that I was at the office and everybody was there. They were doing these 3-day retreats up in Big Bear and renting it out at like $2,000 a night for his cabin. And, I had to sit him down and say, hey, everybody was in the office. Everybody has emails going out, everything else. Like there's no way you could prove that this event even happened or anybody went. And then if you've got an auditor ask your employees if they went or if this event even are you going to ask your employees to lie for you because you're getting audited? And so that's where you need to bring up to your client that these things really need to happen because you can't expect anybody to lie on your behalf, things of that nature. And so they were saying there's company retreats 2-3 times a year and renting his cabin out, which is a great idea if you invite your staff up to your cabin for a company retreat, and then rent it back to yourself, sure. But everybody's got to actually go.
So eligibility wise, then we're looking for legitimate business use. And typically it's going to involve other people or hosting some kind of an event, either clients, customers, or team members or some combination, right? And then you have to actually do it, not just imagine that you could have done it. And then you mentioned that we also would need to, either we or the client, but I guess the client would take the final responsibility, needs to establish some kind of a reasonable value for the rental.
Correct. And then you want to have backup.
And then it has to be, value. And then it can't be more than 14 days throughout the entire year. So that sounds like the initial sort of eligibility of whether someone's looking at actually doing this, and those are the boxes that we need to check, right?
Correct.
Okay. So let's say that happens, right? Let's say you check all those boxes. At this rate, it might even be a client, right, Darren, that they heard about this on the internet and they went and did it during the year and they were or tried to do it, and now they're bringing it to us to kind of get it administered, right? So in terms of administering it, so at that point, I'm going to enter a rental expense on the company tax return, and on the personal tax return, am I going to issue a 1099? Am I going to report that anywhere on the personal tax return? What do I do on the personal return?
On the Augusta Rule, I don't report it on a lot of them. A lot of the times you can put it on as rental income and then deduct it as an expense and then cite the IRC code on it in a note.
And is it acceptable to, because, my policy, if I don't have to do something, then I try to not do it. So it's kind of like a little either or type of scenario. So what if I just don't put it on the 1040 at all? Is that
at all? Then
I'm not a bad person?
I don't think you're a bad person if you don't put it on at all. There's not any requirement that says that you have to put it on and take it back off.
I thought that was the whole appeal to it, is that you don't have to report
Correct.
for that.
Yeah.
I mean, you report the expense on the.
Yeah, the only time that I've ever reported it is when it's through a third party, like from a movie production company or something like that, and there's a 1099.
Gotcha. Where you're just trying to address the 1099 reporting and make sure it's not
correct. And I don't 1099 the owner of the company, because then that just as far as the red flag goes. I mean, you don't want a W-2, a 1099, and a W-2, a 1099, and a K-1 going out to the same social security number.
Yeah. Okay. And then so I can see why this has become popular, right? Because it's like you're getting a write-off. You don't have to bring anything into your personal return, and you're making a non-deductible expense that you already had for something that you presumably enjoy, your own real estate, right? And you're now getting a tax write-off for some portion of it. So I can see why, and you don't have like a lot of administrative hassle or something like that. Do you feel like there should be some kind of like written lease or terms of service?
There should be an agreement, like some short-term rental agreement, something even one page, like this company's renting this place for the night or for the day, and what the event's for, and the price. And then that's the other thing too, is I don't like reclassifying distributions for these types of things, because that just doesn't hold water at all. I mean, you want to have an actual either check written from the company to the owner, or a specific transfer with a memo on the transfer that it's for this, for event space.
Yeah. And so speaking of reclassifying distribution, so I think have talked about this a few different times, where the owner, a lot of times with these smaller companies especially, right, is just kind of drawing out money, as they can and need. And then after the fact, you may have some things that you could reclassify, like vehicle expense, or where they had business use but they weren't being reimbursed by the company. Is that something very commonly that we do during tax preparation, is look at those kinds of things, right? And so with this, the idea of, okay, you did have business use of your home, let's say it is, that meets this definition. Maybe you didn't even know or were planning that there's this, but to me, it sounds like that. Are there any circumstances where I would continue to not be a bad person, and then I would reclassify some of those distributions?
Yeah, it would have to really line up, though, because you couldn't really just, you would have to see, well, and that's where too, though, is, and what I like to do for my clients is turning things that are not deductible into things that are deductible by doing it correctly.
Right.
And so if you get into the conversation, let's say, as you said before, like, let's say the client brings it up to you, and they're like, hey, I saw this thing on the internet, the Augusta Rule, why am I not doing this? And so that's where my first question to the client would be is, well, did you do anything that would constitute the company renting the house from you? If they're like, well, yeah, I had, everybody over for this big, huge dinner party. And so then you would go back and look and say like, oh, okay, well, you should have rented it from it. You could go back and look. And I would say timeliness is an issue, to see if there was a distribution around the time of the event.
Right.
And then I wouldn't just cherry pick it and do a year-end journal entry against it. I would make sure that there was some type of journal entry or some type of distribution around then. So everything for an after the fact, it would all kind of have to line up so that it looks timely. And say like, oh, okay, on this one they did a $5,000 private distribution, and an extra $1,000 was to rent the place for the night if it was around the time of that one. And so I would say if it all lined up, you could.
Okay. And so if you, let's say you had like 10 days of business use, and you were able to legitimately assign, like, let's say it's $1,000 a night for the self-rental home usage, you would think as a tax preparer that, well, I need to still make some kind of like consideration of my personal use during that time. It almost starts to fall into that too good to be true type of territory, right? Because I don't need to make, it's almost like during those 10 days, Darren, I didn't make use of my personal home for my personal home, right? I just writing off like the entire thing as even more than the entire, I'm not like I'm just writing off my mortgage. I'm actually writing off like, it seems too good to be true in a certain way.
Yeah. I mean, it does. And that's why you got to cross all the T's and dot all the I's. And you can't just haphazardly do it because it does seem too easy to do.
Okay,
but
so
there's all these little things in it that under audit, it's not going to pass muster.
Yeah. Okay, so the kind of the price I pay for it being too good to be true and reducing my taxes by, let's say I have a $10,000 deduction, I'm at a 40% tax rate, I just saved $4,000.
Yeah.
The price I pay for that is having to do it correctly, make sure it's defensible. And on that same note, Steve had a question that dropped in the chat. And this is a common concern that I hear a lot about is can you get in trouble for not issuing a 1099 to yourself? Or would you recommend they pay with a credit card, which I guess would even generate now potentially a 1099K?
Yeah, well, you couldn't really run a credit card because the owner would have to have merchant services set up under their own name. So you couldn't really do it through a credit card. They got the new reporting requirements. I guess you could do it through. Is Zelle 1099?
No.
So, I mean, you could Zelle it. Yeah, there we go, Steve, for Zelle. So, yeah, so you could Zelle it.
But no, it seems like, when people say it's like, no 1099, like, really? Are you sure? Are you?
Yeah, so you're a vendor and everything else. I never have 1099 on it because then you'd have to wipe it off anyway. But I think you could make the argument that it's not income to the person, and so but you do pay more than $600 to an individual. So I guess technically you should 1099 on it.
Yeah, I don't believe you're required to, in the sense that if we think back to the Augusta Rule itself and why it was created, it was created specifically so that these people that were renting their homes during the Masters tournament did not. Yeah,
and they're not getting 1099. The problem is now you're bringing in a business, because that's where Augusta Rule itself is when you're renting out your property to other people, not to your own company.
Right.
And so, the other individuals that you're renting it to, if you did through a service, you might get a 1099. If you did it through Airbnb or VRBO or something like that, you would get a 1099, and then that's when you got to offset it anyway. So, but as far as could the company get in trouble for 1099, I got to go with technically yes, but I would want to say I'd just argue that in audit that it didn't need to be reported anyway.
Yeah, maybe even on this webinar, someone could look that up and do some research if you want to tackle that and drop a link in the chat or and this is
and for Tosin it wouldn't. It's not an accountable plan expense because the owner didn't cover any expense.
Right.
There's no receipt there. So the only way you could do it on an accountable plan would be as if which wouldn't involve the actual property. Let's say the owner rented out a banquet hall on his personal credit card, then you would have an actual expense to reimburse. So as far as getting it under an accountable plan, you couldn't really do it that way because accountable means there has to be an actual expense.
Yeah, I was gonna make that point or bring up that issue, right? Is that this is a separate consideration from having, like, for example, a home office at your home and for a corporation, right? And you're getting an accountable plan reimbursement each month for that utilization of your home. This is a separate scenario to that, although still, in the vein of getting tax write-offs from your personal home, right, that you normally wouldn't have, but that's a separate from this, right, Darren?
Correct.
Okay.
Yeah, because and with the accountable plan, there's got to be the underlying expense. And so, and another couple key things to, think about as well as that makes it easier or more justifiable too, is if the if the client has, other personal like rentals or second homes, third homes, vacation homes, makes it more plausible. I've even got a client that has, a second home, but when out of town customers, there's been some times that people have come in and they've let them stay at the place, for 10 days or so. So that's another instance that's kind of out of the box, if you will. But if they ever have, like out of state customers or consultants or things of that nature, have had them come back in and been able to, we've had the company like pay for their stay, but then you're talking market rate at a hotel, which is like, $350, $400 a night, even for 10 nights, $4,000 write-off, saves you, $1,500, minus QBI deduction. So you're talking $1,200. So that's where it's how much time do you want to spend on this? That's where the internet makes everything so grandiose. But a lot of the times when you boil it down with the client and everything else, they might be saving like $500 in tax.
So does this fall into a strategy then for you that is kind of overrated and not really that important, do you think? Or just specialized, I guess?
I believe I'm loving this discussion this morning because it's giving everyone the questions that ask their client. So it's to give them the information, be like, hey, yeah, that's there. Let's take advantage of it. Here's what you need to do. And so it kind of puts it a little bit more on the client side if they're, if they're willing to do it or not. So then you look like you're doing everything you can to save them money. Okay. And then if they do it properly, then they can save the money. So it's about having that conversation. A lot of new clients that I get and things like that is their accountants just say nope. And that's where it comes down to working with them a little bit to say like, yeah, this is something you can totally take advantage of. If they're like, why didn't you ever bring it up to me before? It's like, well, you don't do client events. So, it didn't really pertain to your business. So I didn't bring it up. Now that you're concerned about it, let's talk it through and see if we can discover a way to make it work. So it's definitely, a 10-minute conversation that can build, client relationships and retention. Yeah.
Interesting. Okay. David, you had a question or a comment?
So I don't deal with a lot of S corps. The ones I do are mostly service-based and don't have a need in the sense that you're talking about, but they do have an obligation for their monthly minutes. And so I'm wondering, would they be able to rent their house out if they had some sort of like board meeting to discuss the business, and, write down these corporate minutes that are required monthly? Because that would give us 12 days within a year. Now, if it's only $100 a night, we're looking at a $1,200 deduction, 40% tax. It's only $400 or between $400 and $500, like you were saying. So, it may not be worth the effort, but is that something that would kind of make sense for S corps?
Well, here would be my walkthrough on that is that, one, if they have monthly, most corporations, you have to have an annual meeting, I think. Unless their, bylaws state that they have to meet monthly. I think you may have issues on ordinary and necessary. Like, do you have to rent out your whole entire house to do your board meeting minute? No,
it would be relatable to if I were to rent a conference room at the local workspace.
Yeah. Yep. And do you have a board of directors or is it just you?
Exactly. So would it be me Or, I mean, in my sense, I would probably try to find a couple other small business owners and have a meeting about, the status of the business for the month, and then review accountable plan stuff, and then write down your minutes and then move on.
Yep.
Yeah. So, I mean, in that case, yeah, I like it.
But see how you can see how, like Darren, he puts you on the spot about it too. And if you have an actual legitimate business reason that you're doing something at your home, I feel like that's the reason we have the loophole, is because it's is there to be used and enjoyed in the right way. It's interesting though, because I know too with your current way that you're doing some of your marketing, David, is you're reaching out through these in this educational way towards other small business owners, right? So it's almost like you're going to start doing something that's needed, you or even one of your clients doing something that we should be doing as business owners. We're currently not, and we're almost like being motivated by this tax loophole to do something that potentially can really help the business. So things like that, I think if you can justify it and make it where it's actually a legitimate business use, I think it sounds great.
Yeah, and that's the difference between things that are abusive and or not, and that's where if you're a S corp and you're the president, treasurer, and secretary, and you're the only director on the board of directors, there's no reason to rent your house out to yourself to do your minutes. And chances are you should probably already be doing home office on the accountable plan, right, which so you've already covered because you're using the home office to do your minutes. But that's where it's in talking it through with your client, and David, is why you keep asking questions. And so if you invite a couple of other businesses over to discuss and everything else, and so you're using your place in lieu of renting, the conference room or a room out at a restaurant or, one of those shared workspaces, something like that, then 100%. And that's the difference between being smart about it and, or just being abusive and doing something that'll probably get overturned in audit anyway. And I explain that to my clients is like, here's how you do it. And here's, this makes it legitimate rather than just doing a bunch of stuff that's illegitimate and losing sleep.
I like bringing it up as an option initially because then it kind of quashes that. Has he looked into it? Yeah. You can tell him like, okay, this is like, if you do this very basic thing that could be required by most S corporations, this is about how much it's going to save you. And this is how much it's going to cost you. And then they can kind of make the decision from there. And I found in most cases, they're like, it's not worth it. I'd rather spend my time making money than trying to find deductions.
Interesting.
I like it.
Tosin had I wanted to make sure we didn't miss this, had a question about this would not be for partnerships, would not be an option or would be an option?
I think with an LLC, well, would it be considered a guaranteed payment?
No, I don't think so. Let me, there's a couple other questions in there too. Let me see if I can look that up, Darren.
I think it would be the same as a corporation or an LLC. Unless there's something that would deem it a guaranteed payment.
Yeah, I don't see it being.
I would say a hard no on a single member LLC.
Why? I mean, why can't I do an event company if I'm a single member LLC?
Yeah, or even Schedule C. I guess I've only done it with events. I've never ran it on Schedule C.
I chatted you there, Tosin, and everybody else. The partnership should be okay. Again, provided that it's done correctly. Isn't it? Yeah, it's not. No, it's not. It's not a guaranteed payment for services rendered because it's not. It's not a service. It's a rental of a. of your home, right, Darren?
Yeah, and then so I've got looking on a thing. It doesn't have the backup, but I'm finding a couple of things that just say if you're a sole proprietor, single member LLC filing as Schedule C, it's a no dice. It has to be a separate entity.
Okay.
I think, and this is just where from in the back of my brain is, if you're only a Schedule C, there's no differentiation. You're a sole proprietorship, just an individual. So I think it may fall under apportionment of income. So you're not allowed to just say poof. There has to be some type of differentiation with an actual entity. And so, but yeah, I'm seeing a couple of different things that just it's a no-go on Schedule C, which I always thought. So I've never done it that way. I've only considered it. Probably heard in a seminar 15 years ago that you can't do it. But as far as and that's where, well, and you don't run into the self-rental rules on Augusta Rule is not self-rental rule. That's a whole different matter. Self-rental rules is when you run into the over 14 days. And you got to start reporting the income.
Right. Okay. So the self-rental rule refers to the length of time that you can receive the rental income without paying tax on it or even reporting it.
Correct. Yeah. Because once you're over the 14 days, then you're in a whole nother territory. Then it's an actual rental.
Right. Where you're having to
or vacation rental and everything else. Yeah. Then you run into vacation rental rules and everything else and self-rental rules. So that's where everybody focuses on the Augusta rule because it's a non-issue. Just looking back at the notes here, we had that one there.
Yeah, and who else too? If anybody wants to chime in, looks like Marley has something to add. But if you have personal experience, like you've tried this before or you've seen a client do it, I mean, these are great forums for people to hear, like from not just book learning, but what's going on in the real world.
Yeah, and I'm looking at Felicia discuss when it's a second home that is rented to a business on a monthly basis for usage as assisted living. What would be the effect and right way to report? If S Corp. So if you have an S Corp that's an assisted living and it's renting the property from you to do the assisted living, that would get into, I mean, it's rental expense for the S Corp and rental income for you. It goes on Schedule E, but you would run into the self-rental rules, which we can't get to. So doesn't really apply to Augusta or anything like that. That's having a working relationship between rental property that you own and a business running out of it. Steve, isn't a guaranteed payment for services rendered. And then agreed. That was where Steve was saying that it could potentially be a guaranteed payment.
Go ahead, Marley.
I think we had this conversation in one of Andrea's session, and it was it started because she was having the meeting on a backyard that was beautiful. And it happens to be that she was just sitting. It's like, Andrea, where are you? And I go, in my backyard. And I go, well, it's beautiful. So we had the discussion that because I was confused if an S Corp, a single member LLC that chooses S Corp status, has a home office and also a beautiful backyard, whether you can take the Augusta rule if you're hosting the company retreats, quarterly meetings, in your backyard, as long as it's not the same room as where your home office is. And from what I remember from the discussion, is like as long as the space is separate, you have a home office, you submit the home office reimbursement through the accountable plan, and in lieu of renting a space somewhere else, like a hotel or a restaurant, you you use your backyard and you cater the event and so the site fee that you would have had to pay somebody, reasonable site fee, obviously, you could allocate that as the expense, as when you tally up all the expenses to host this event for your employees or your clients or your vendors or whoever. And that piece could be the Augusta Rule deduction, the site fee that you're saving by using your backyard as the place to host the event.
I would agree with that.
Now, from what I just read on article on Andy's link, you cannot use this strategy if you are a single member LLC being disregarded entity on a Schedule C. This would only work if you actually are S Corp then.
Correct. Yep. No Schedule C, no single member LLC. That's reported on.
If the single member LLC chooses S Corp status, then
then you're taxed. You're filing 1120S.
Yeah, exactly. So this only works is if you have an entity outside. But if you are a disregarded entity, you cannot claim the site fee as a deduction then.
Correct.
Okay.
Yeah, and use the Augusta Rule to not pay tax on it.
Mm-hmm.
Well, and I think one of the issues with that there too, though, is then you're getting out of self-employment tax because you're basically shifting income from the Schedule C over to Schedule E.
Yeah, I guess that makes sense. Yeah.
So I would agree, but I would 100% agree with that. So, and that's tying back into like what David was saying is I think you would have an issue, with a S Corp that you have one person that's the director, the president, the secretary, everything else. Then there would be no reason to rent a space outside of the home office. But if you have multiple people and everything else, and you're having it either in your backyard or taking over the whole downstairs because there's more people, then that would fall outside of your home office. So I would totally agree with that. And so everybody's going to Marley's backyard.
Yeah. And
we're going to Andrea's backyard.
Oh, it was Andrea's backyard. That was so pretty. Okay.
Yeah, I think this recap from Steve in the chat. So just to recap, Schedule C clients, single member LLCs, and partnerships cannot use the self-rental rule unless they are corporations. I think that's actually not correct, right? Because single member... not self-rent. It's Schedule C, single member LLCs. I believe partnerships can. They can.
Because they're filing Form 1065.
Yeah.
And so, and it's not self-rental rules. It's the Augusta Rule, using the Augusta Rule. Self-rental is complete. Self-rental has pitfalls as far as passive losses go when you're renting between related entities, which is usually yourself and a company. But that's for ongoing use more than 14 days.
Ongoing use more than 14 days. Okay. So then Augusta is different than self-rental in a bigger way. It's like two different topics. Is that right?
Great. Two different topics. So what I would say is if the renting of the property goes over 14 days, then you could run into self-rental rule issues.
I see. Okay.
If it's less than 14 days, then you have a good chance of using the Augusta Rule to not pay tax on the income.
Gotcha. Okay. So it's almost like I led us down this rabbit hole of this meeting of being about something different than we advertised the meeting to be.
Correct.
Okay.
But which is good, though, because it's more practical.
Oh, yeah.
And so, and this is information that everybody can use. And that was where even going into this morning with self-rental rules I was going to do a lot of Q&A because it was really self-rental rules. You just run into pitfalls when it's as far as like you have to be very careful on setting the rent, one, that it's market value, two, that you're not running up huge losses on the personal return, because under self-rental rules, those losses can't be used to offset other income, things of that nature. So you can end up, there's some certain limitations on self-rental that can basically shoot yourself in the foot, but it's all regarding passive losses.
Okay.
So it's just a couple of things that you got to be careful of when it comes to self-rentals.
So then we could have some more material available for delving into that topic.
Correct.
That
Yeah.
may be like, one of these shell games where you're trying to move numbers around between your entities so that you can decrease the tax rate. But if you're renting from yourself, then they could know that you're trying to do that and
which is fine. But yeah, what can happen is you can run into issues where, you can end up with losses that are suspended in a way that other passive income won't offset it.
Yeah, gotcha. Okay. So I think that would be something great to, especially for multiple. I find that once people have like a successful business, they usually have either other businesses that they're involved in, and rental properties. So that was
and where this Augusta rule is a lot more important is this is what people are going to use with their clients.
Right.
Self-rental rules falls into like your company, your business has to be making enough money that you bought an office building and you put it into an LLC, and then have your corporation rent your office building from your single member LLC that owns it. Or like my client that bought a $4 million property in Ojai, but it basically created an LLC to handle the VRBO portion of it, and then it rents it back that goes to an E because couldn't put the name of the property in the LLC. So it's really very special circumstances where you're even going to run into self-rental rule, as opposed to the Augusta rule pretty much touches everybody. And so it's something that's much more commonplace.
Yeah. Okay. I appreciate you making me feel better about that. That was very therapeutic.
Yeah.
And
how to handle it with the clients, because it's also one of the things that, you don't see advertising all over the internet of is your accountant taking advantage of, self-rental versus, the Augusta rules everywhere. And
so would you say it's possible for me to actually have a board meeting with myself?
I don't think so. You should be doing home. I'd say that would be more accountable plan in home office.
Okay. So we're deciding, you guys, to focus over the next really 2-3 months for some of these sessions and some other trainings that we'll be doing on Schedule E on real estate investor clients. I wonder if Darren, you could talk for a couple minutes, and for anybody else that has any comments about it. As I was thinking through, like, which training is going to make the biggest difference for our members, this was the one that kind of went to the top as being, very valuable, very much a differentiator in the marketplace. I wonder if because I know you work with a lot of real estate investors, everything from, long-term rentals, short-term rentals, flipping, every combination thereof. Can you, like, the mentality of the client? I know it's hard to generalize, but I have always found that landlords are very interested in lowering their taxes, and that's a lot of times one of the main reasons they got into buying real estate. Can you just mention, like, as we're envisioning this client group of like what they're going to value, kind of how they think about taxes, any comments on that?
Yeah, well, and I think it boils down to setting up a client expectations from the beginning, and that it is, flippers versus, like rental real estate investing. You're going to have much more immediate things for flippers, completely different set of laws. Flipping would be its own individual category. Then as far as if they're going to get into the residential or commercial or triple net rental markets, that's its own part, because it's about setting up client expectations, especially if they're beginning, because with the way that rental losses get suspended, you really got to have an upfront conversation with your clients that, hey, this thing's going to run a $30,000 loss, and it's going to carry over every year. But that's where it's time to, up your fees, do long range planning with your client, to be able to show them too how it'll benefit them in the future of all these losses carrying over. And also, you don't want to fall into the mentality of all these losses are going to carry over, so I don't need to be that careful or cautious, making sure that we're writing off everything possible. It's like, this thing's going to carry over for 30 years and run a loss for 30 years. So, do I need to worry if I get the mileage in every year? So I think that's where a lot of people fall short is this loss isn't going to do any good till a time in the future. So I think a lot of accountants out there overlook maximizing the deductions on a Schedule E and the rentals. They just don't dig that deep in because they're not getting that immediate payoff for their client. Like Schedule C, it's like, I just lowered your tax bill. Look, but it's like, okay, we spent all this time and did all this stuff. Yeah. Your passive loss carryover increased by 10 grand and it has no net benefit. So that's where I believe some of it comes down to like client education and expectations of, running the long game of it, which is huge. So I think that on Schedule E, in which if everybody here would be would like this, is I would like to just do like or I don't know if anybody else had, but just a Schedule E deep dive, from one rental to 10. But what can they write off? How should you dial in the mileage between them? Can you take their financial advisor fees? So here's one that I never did that got brought up to me. So here's something I missed, which completely makes sense to me, and I do it now. So if they have a financial advisor that is charging, let's say 10, 12 grand a year, 1% of their portfolio. How many of you guys have been taking a little because I always put a portion of my tax prep fee on the Schedule E because I did it, but did they discuss their rentals with their financial advisor? Is a part of their financial plan. So have you been taking, going through the 1099B, going to that back page where it has the advisor fees and taking a percentage of that and putting it on the Schedule E? I didn't.
Well,
I never did that till like 5 years ago. I never even thought of doing it.
And things like that, Darren, is because these typically are networks clients that, like, when they get into real estate investing, they're going into like chat rooms, they're going into groups, they're attending events. And so when you're doing those kinds of things and you're finding these type of like, legal and ethical loopholes, so to speak, or bringing more strategy. Hey, let's see about this. Or, you're playing the long game with your real estate investing, because a lot of times in the first part of the property, right, they're fixing up the property, they're not making money, right? So they're playing the long game themselves. And now you're getting on their level and saying, well, this loss is going to carry over. So I'm playing the long game with you. I see what you're doing. I'm on the same wavelength for you. And then because they're networked, and the other service providers are not doing that in a lot of cases, right? They're able to refer, 3 clients per year, 5 clients per year, 10 clients per year, and the referrals are coming in a way where it's your service is pre-sold as more of a premium, premium service that's actually tailored for that person's.
Correct, and that's one of the industries where they want to hear that you're like specialized in it. They really want somebody that's like works with a lot of real estate clients. that really is kind of it's a niche market, and those are clients that want that edge, that it's something you do a lot of, that you specialize in it, that it's something that's specialized is a good word, that it's something that you pay special attention to and that you're really good at. And then that way, it can grow from within that network, because they are always talking to different people doing different things, everything else.
Can we also cover like vacation rentals when you have a second home, and how you keep track of personal use days versus days that you're there but are working in the property, so they are not considered personal use days? And things like that for Airbnb, especially for Airbnb, people that have Airbnb, and what constitute a personal day versus a non-personal day, and what kind of record they should keep?
Yeah, and that's where too, Andy, is I like that that we're going to take this over the score of a long time, because that's where too, though, is which I can end up going off on too many tangents sometimes, because that's where just one thing bleeds into another. So which I would like to, like today, I like keeping it focused, like Augusta Rule. Let's talk about that. So what I would say is next Monday we can do, Schedule E deep dive, but income expense on the Schedule E. Let's just keep it focused, because we can do a whole nother Monday on setting up a rental, cost segregation, depreciation, things of that nature. How do you determine the basis, everything else? It's very, because you can start getting into the Schedule E, and then all of a sudden you talk about depreciation, and then it's a whole nother topic. And so I like keeping them, like a whole Monday can be vacation rental, and we'll stick to just that. And so I like that. So next Monday I can do basically Schedule E deep dive, like just income and expenses, just line items, what you can do, what you can, change things into, how to make some non-deductible things deductible, out of state rentals, even foreign rentals. Yeah, may touch. I saw foreign in there. That would be its own day. Foreign would be. So a lot of different reporting on it. So that could be a whole Monday. But so I would say right now, next Monday would be Schedule E deep dive, income and expenses, and just getting the most out of it and maximizing the deductions for your client. What to go over with your client to make sure that they're tracking everything properly and deducting everything that they possibly can.
Awesome. I think that'll be a great session. Okay. Thanks, you guys, for the suggestions too. I'm glad people seem to be resonating that doing the Schedule E training series in terms of mastery, confidence, and really acquiring these kind of clients and feeling confident of our value is a priority for people. So that's exciting. We've got 2 minutes, Aaron. Tammy said something off topic.
Yeah, can we do them? I don't know if they ever, I haven't seen anything if there was ever a definitive answer if we can do them or not. So I'm not doing them. I put them over to, I either tell the client to figure it out or do it through CorpNet.
Yeah, I think the definitive answer, Tammy, was that you can, as long as you don't provide legal advice during the process. So whether you should might be a different consideration, but they did come out and say it was okay for accountants to do them. Yeah. And so I guess that's, you can, but should you? I don't know. Really one of the great questions of life.
Right. And one thing I will say, though, is, and there's not a bunch of stuff. I already had one that almost missed the 90-day deadline on a new entity.
Yeah.
They're not really pushing that out there. Yeah. And so, I already had one that almost missed the 90-day deadline. So they're not really pushing it that much. And so the new ones are not, maybe or maybe not doing it. And that's where your clients don't always tell you when they do it, when they form a new entity.
And I just explained what the terms mean to the client. I didn't fill it out. I had them fill it out, and they're like, well, okay, what is this person? And I'm like, well, that is whoever is filling out the form. And they're like, so that's me. Yes. Okay. So that was a way to not actually do it for them, but make sure that it still got done.
Yeah. Yep. And so with that one there. All right. Good to see you, Andy.
Thanks, guys.
And everybody else, thank you for tuning in today. I greatly appreciate it on behalf of myself and Pronto. Appreciate everybody's time. All right, you guys.
Thank you.
Have a wonderful Monday. Bye-bye.
Thanks for watching. If you found this session helpful, we invite you to join our Pronto Tax School memberships. You'll get access to weekly live mentor support sessions like this one, plus tons of advanced tax course trainings, private groups, special discounts to in-person events, a tax business growth coach, and so much more. Check the links in the description to learn more about our Dream Team and Forever Edition memberships, and join us today.